Imagine a room. A quiet room. Thick carpet. Mahogany tables. The air conditioning is set to a perfect 70 degrees. Inside this room sit 12 men and women. They are not politicians. They are not generals. They are not celebrities. But they hold the fate of your future in their hands. These are the board members of a major pension fund. Collectively, the global pension system controls over $50 trillion. That is more than the GDP of the United States and China combined. For decades, their strategy was boring. It was predictable. It was safe. They bought stocks. They bought bonds. And they went to sleep. But something has changed. In that quiet room, panic has set in. The math that held the world together for 40 years is breaking. The calculator is showing an error message. And to fix it, they are doing something that was once considered professional suicide. They are buying gold. Not paper gold. Not ETFs. Physical bars. Tons of it. They are moving it into vaults in London, in Zurich, in Singapore. Why? Because they know 3 accounting secrets that the news will never tell you. They know that the safe assets aren't safe anymore. And they are terrified that when the music stops, they will be the ones left holding the bag. This is not a story about jewelry. This is not a story about trading. This is a story about the plumbing of the global financial system starting to leak. And the only patch left is a yellow metal that yields 0%. Before we open the books and show you exactly what they are hiding, I need you to make a choice. If you want to understand the game being played with your money, you need to be in this loop. Hit that subscribe button right now. Like this video if you want the truth. And tell me in the comments, do you trust your retirement fund to actually pay you in 20 years? Yes or no? Because after you hear this, your answer might change. Let's begin. To understand why this is happening, you have to understand the nightmare scenario for a pension fund manager. Their job is simple. They take money from workers today. They invest it, and they promise to pay it back 30 years from now. It sounds easy, but it relies on one massive assumption. The assumption that the money will grow faster than inflation. For 40 years, this was true. We lived in a world of falling interest rates. When rates fall, bond prices go up. Stocks generally go up. It was the golden age of the 60-40 portfolio. You put 60% in stocks, 40% in bonds, and you looked like a genius. But look at the world today. The golden age is over. We are in a new era. An era of volatility. An era of sticky inflation. And most importantly, an era where government debt is no longer risk-free. The pension funds are waking up to a terrifying reality. The bonds they bought to keep your money safe are actually the most dangerous assets on their books. This brings us to the first major problem. The death of the risk-free rate. For a century, U.S. Treasury bonds were considered risk-free. If you bought a 10-year bond, you knew you would get your money back, plus interest. But what happens when inflation is running at 4%, and the bond only pays you 4%? You make nothing. Your real return is 0. Now, what happens if inflation is 5%? And the bond pays 4%, you are losing money every single year. This is called negative real rates. And for a pension fund, this is cancer. A pension fund needs a real return of about 7% just to break even, just to keep the lights on and pay the retirees. If they are holding billions of dollars in bonds that are losing value in real terms, they have a hole in their balance sheet, a massive hole. So, they look for alternatives. They look at real estate. But commercial real estate is crashing. Office towers are empty. They look at private equity. But that is illiquid and dangerous. And then, they look at gold. Now, standard finance theory hates gold. Warren Buffett hates gold. He says it just sits there and looks at you. It doesn't pay a dividend. It doesn't pay interest. It has no cash flow. So why would a pension fund want it? Because in a world of negative real rates, zero is better than negative. Gold maintains its purchasing power. A defined weight of gold buys roughly the same amount of bread today as it did in ancient Rome. Bonds do not. Cash does not. The pension funds are realizing that the risk-free return of bonds has become return-free risk. And suddenly, a bar of gold that pays zero, but cannot be printed into oblivion by a central bank, looks like the most responsible asset in the world. This leads us to the deeper issue, the structure of the market itself. We have to talk about correlation. This is a technical word, but it is the reason your portfolio might get wiped out. Correlation measures how two things move together. If stocks go up and oil goes up, they are correlated, ideally. A pension fund wants assets that are uncorrelated or negatively correlated. They want balance. The theory was simple. When the economy is good, stocks go up. When the economy is bad, central banks cut rates, and bonds go up. So, if stocks crash, your bonds act as a parachute. They save you. This relationship, stocks up, bonds down, or stocks down, bonds up, is the foundation of modern finance. It is the bedrock of the 60-40 portfolio. But in 2022, something impossible happened. Everything fell. Stocks crashed. Bonds crashed. Real estate wobbled. There was nowhere to hide. The correlation went to 1. Imagine being a pension fund manager in 2022. You have billions of dollars to protect. The stock market is bleeding red. So you look at your safe bonds, and they are down 20%. Panic. Absolute panic. The parachute didn't open. This is where the accounting secret of gold comes in. Gold is one of the few assets on Earth that is truly uncorrelated to the financial system. It is not someone else's liability. A stock is a claim on a company's earnings. A bond is a claim on a government's tax revenue. A bank deposit is a loan to the bank. Everything in the financial world is a contract. It relies on someone else fulfilling a promise. Gold is not a promise. It is an asset. It stands alone. When the correlation of stocks and bonds goes to 1, when everything sells off together, gold often detaches. It does its own thing. In 2022, while stocks and bonds were getting slaughtered, gold held its line. It finished the year roughly flat. In a year of destruction, flat is a victory. Pension funds are mathematical machines. They run complex models called optimizers. They feed in data about risk and return. For years, these models said, buy bonds. But now, because bonds and stocks are moving together, the models are spitting out a new answer. They are saying, add diversification. And when the computer searches for something that doesn't move with stocks and bonds, it finds gold. This is not an emotional decision. They don't like gold. They don't care about history. They are just following the math. The math says they are too exposed to the financial system. They are too exposed to the dollar. They are too exposed to interest rates. They need an anchor. And gold is the only anchor heavy enough to hold the ship. Let's go deeper into the accounting. We need to talk about liability matching. This is the heart of the pension crisis. A pension fund has liabilities. These are the monthly checks they have to send to grandma and grandpa. These liabilities stretch out for 30 or 40 years. They are very sensitive to inflation. If the cost of living goes up, the pensioners demand more money. Cost of living adjustments. COLAs. This is a nightmare for the fund. If inflation spikes, their liabilities get bigger. They owe more money. But do their assets grow? If they are holding nominal bonds, no. The bonds pay a fixed rate. So, inflation makes their debts bigger. but keeps their income the same. This creates a funding gap. This is the terrifying gap between what they have and what they owe. If that gap gets too big, the fund becomes insolvent. It goes bust. The government usually has to bail it out, or the pensioners get pennies on the dollar. So how do you hedge this? How do you protect against a liability that grows with inflation? You need an asset that grows with inflation. Historically, that was real estate. But real estate is illiquid. You can't sell a skyscraper in an afternoon to pay monthly checks. Stocks hate high inflation. Companies face higher costs. Profits go down. So where do you go? You go to the asset that has tracked inflation for 5,000 years. Gold. But here is the secret. It's not just about inflation. It's about tail risk. Pension funds are terrified of black swans. Events that are supposed to happen once every 100 years, but now seem to happen every 5 years. The 2008 crisis, the 2020 pandemic, the 2022 inflation spike. In these moments, liquidity disappears. You try to sell corporate bonds. No bids. You try to sell mortgage-backed securities. No bids. The market freezes. For a pension fund, a frozen market is death. They have to pay checks every month. They cannot tell the retirees, sorry, the market is illiquid, wait until next month. They need cash. If they can't sell assets, they die. Gold has one specific property that makes it irresistible to these accountants. It is the deepest, most liquid, non-sovereign market in the world. You can sell $1 billion of gold in London in seconds, and the price won't crash. During the worst moments of 2008, when everything was frozen, gold was liquid. Pension funds are starting to view gold not as an investment, but as a liquidity buffer. It is cash that doesn't lose value. It is a rainy day fund that actually works when it rains. Think about the psychology here. These fund managers are conservative. They are terrified of looking stupid. Buying Bitcoin, too risky for them. Too volatile. If they buy Bitcoin and it crashes, they get fired. But buying gold? Gold is respectable. Central banks own it. Governments own it. It has a CUSIP number. It is regulated. It fits into the spreadsheet. This is the career risk aspect. A fund manager can justify buying gold to their board of directors. They can say, look, the Bank of England holds gold. The German Bundesbank holds gold. We are just being prudent. It is a defensible position. And in the corporate world, being defensible is more important than being right. Now, we arrive at the most significant shift in the last 20 years. This is the smoking gun. The regulatory change that almost no one noticed. It's called Basel III. This sounds boring. It sounds like paperwork. But it is the reason gold is moving. Basel III is a set of global banking regulations. It decides how risky different assets are. For decades, gold was considered a Tier 3 asset. It was considered risky. If a bank or institution held gold, they had to hold a lot of cash against it. It was expensive to own gold. The regulations discouraged it. They wanted banks to hold government bonds. Bonds were Tier 1, risk-free. Gold was speculative. But recently, that changed. Under the new Basel III rules, allocated physical gold was moved to Tier 1. Do you understand what that means? It means the global regulators, the people who run the system, are now classifying gold as zero risk. They have put it on the exact same level as cash and U.S. Treasury bonds. This is a signal, a massive, flashing, neon signal. Why would they do that? Why would they make it easier and cheaper for banks and institutions to hold gold? Unless they knew that the bonds were becoming risky. Unless they wanted to encourage the system to recapitalize with hard assets. Pension funds watch these regulations like hawks. When the Bank for International Settlements, the central bank of central banks, says gold is now a Tier 1 asset, the pension funds listen. It removes the stigma. It gives them the regulatory green light to load up. And that is exactly what they are doing. This is the regulatory optics secret. It looks better on the balance sheet now. It counts as high-quality collateral. In a world where collateral is getting scarce, where people are trusting government debt less and less, gold is becoming the premium collateral. Imagine a world where you need to borrow money. You offer U.S. Treasuries as collateral. The lender says, I don't know, the U.S. deficit is $2 trillion a year, these bonds are volatile. Then you offer gold. The lender says, okay, Tier 1 asset. Deal. That shift is happening. It is subtle. It is slow. But it is unstoppable. Let's look at the geopolitical angle through the eyes of a pension fund. A pension fund in Europe, or Asia, or the Middle East. For 50 years. They bought U.S. Treasuries. They parked their savings in the dollar. But now they see the weaponization of the financial system. They saw what happened to Russia in 2022. $300 billion of sovereign reserves. Frozen. Deleted with a keystroke. If you are a pension fund manager in a non-Western country, or even a neutral country, you have to ask yourself a hard question. Is my money safe in New York? Is my money safe in U.S. bonds? If the political winds change, could my assets be frozen? This creates a sovereign risk premium. Suddenly, the U.S. dollar isn't just money. It's a political tool. And pension funds have a fiduciary duty to avoid political risk. They cannot afford to have their assets frozen. Gold cannot be frozen. If you hold physical gold in your own vault, or in a neutral jurisdiction, it is yours. No sanction can touch it. No SWIFT ban can stop it. This is driving a massive rotation out of paper assets and into physical assets. We are seeing pension funds demand allocated gold. This is a crucial accounting term. Unallocated gold means you have a claim on a bank's gold pool. You are a creditor. If the bank goes bust, you are in line with everyone else. Allocated gold means specific bars, with serial numbers, sitting on a specific shelf. They belong to you. They are not on the bank's balance sheet. If the bank goes bust, you walk in and take your bars. Pension funds are moving from unallocated to allocated. They are paying the storage fees. They are paying the insurance. They don't care about the cost. They care about possession. Because possession is the only law that matters when the system breaks. This shift tells you they are worried about counterparty risk. They are worried that the big banks might not be as solvent as they look. They remember Lehman Brothers. They remember how quickly a AAA-rated institution can go to zero. They are hedging against the banking system itself. Gold is the only financial asset that is not simultaneously someone else's liability. Read that again. Every other asset depends on someone else paying up. Gold just is. For a conservative, risk-averse pension fund manager, that simplicity is beautiful. It is the ultimate accounting purity. Now let's talk about the supply constraint. Pension funds deal in size. They don't buy $1 million worth of something. They buy 500 million, a billion. The gold market is actually quite small compared to the bond market. The total value of all the gold ever mined is roughly $12 to $13 trillion. But a lot of that is jewelry. A lot is in museums. The amount of financial gold available for trade is much smaller. Maybe 3 or 4 trillion. The global pension market is 50 trillion. Do the math. If pension funds decide to move just 1% of their assets into gold, just 1%, that is $500 billion of buying pressure. That is $500 billion chasing a limited supply of physical metal. There isn't enough gold at current prices to satisfy that demand. If they try to buy that much, The price has to go up. It has to. This is simple supply and demand. And pension funds know this. They know they are the whales. They know that if they start buying, they will push the price up against themselves. So they are buying quietly. They are buying over the counter. OTC. They are not clicking buy on a public exchange. They are calling bullion banks directly. They are arranging private transfers. They don't want to spook the market. They want to accumulate as much as possible before the rest of the world catches on. This is why you don't see headlines saying, CalPERS buys 10 tons of gold. They don't want you to know. Not yet. They want to fill their vaults while the price is still relatively low. While the retail public is distracted by tech stocks and crypto, they are front-running the inevitable revaluation. This is the accumulation phase. Smart money buys when the asset is boring. They sell when the asset is on the cover of Time magazine. Right now, gold is boring to the average person. But in the institutional world, it is being devoured. Let's look at the optics of inflation. Pension funds have to report their performance to their members. Imagine telling a room full of firefighters and teachers, sorry, inflation was 8%, but our bond portfolio lost 10%, so you're actually down 18% in real terms. They will bring out the pitchforks. The managers need a story. They need to point to something that worked. Gold is that story. Even if gold just keeps up with inflation, it is a psychological win. It allows the manager to say, we protected your purchasing power. We saw the inflation coming. We bought the inflation hedge. It is about narrative control. In a time of economic chaos, gold projects stability. It projects wisdom. It makes the fund look prudent and prepared. This optics argument is powerful. Never underestimate the need for a bureaucrat to cover their backside. Holding gold is the ultimate, I told you so, insurance. If the economy crashes, and they hold gold, they look like heroes. If the economy booms, and they hold gold, they can say, it was just insurance, a small cost of doing business. It is a trade with very little career downside, and massive career upside if things go wrong. We must also consider the de-dollarization trend. This is not just a conspiracy theory anymore. It is happening in the data. Central banks bought more gold in 2022 and 2023 than at any time on record. China, Poland, Singapore, India. They are buying hand over fist. Who watches central banks more closely than anyone? Pension funds. Pension funds know that central banks are the insiders. They run the printing presses. If the people who print the money are trading that money for gold, what does that tell you? It tells you that the money is broken. Pension funds are simply following the big money. They see the writing on the wall. The global monetary system is shifting. We are moving from a unipolar US dollar world to a multipolar world. In a multipolar world, you need a neutral reserve asset. That asset is gold. Pension funds are positioning themselves for this new world order. They are diversifying out of the Western financial bubble and into global neutral assets. This is a strategic geopolitical hedge. If the US dollar loses its dominance over the next 20 years, a portfolio that is 100% in dollars will suffer. Gold is the currency of no nation. It is the currency of the world. By holding gold, pension funds are effectively shorting the current geopolitical stability. They are betting that chaos is coming. And chaos usually pays out in gold. Let's talk about the shadow banking system. Pension funds lend out their securities. They lend their stocks and bonds to hedge funds for a fee. This generates extra income. But it also creates risk. If the hedge fund blows up, the pension fund might not get its bonds back. This is rehypothecation. The same asset is pledged as collateral multiple times. It is a house of cards. Gold is much harder to rehypothecate, especially if it is allocated. Pension funds are starting to demand pristine collateral. They are tired of the complex chains of debt. They want assets that are simple. This return to simplicity is a reaction to the complexity of 2008. In 2008, nobody knew who owned what. Nobody knew where the toxic assets were. Gold is transparent. It is dense. It is heavy. You can verify it. You can audit it. For an accountant, this physical verification is comforting. You can walk into the vault and count the bars. Try doing that with a derivative swap. You can't. This auditability is becoming a key factor. Governance. Boards want to know exactly what they own. They are tired of mark-to-model valuations where the price is a guess. Gold has a global price. It is transparent. It is honest. In a dishonest financial world, honesty trades at a premium. Let's analyze the endgame for these funds. What are they seeing in the long term? They are looking at demographics. The Western world is getting old. The workforce is shrinking. Social Security and Medicare are underfunded by trillions. There is only one way governments can pay for this: money printing, financial repression. They have to keep interest rates below inflation to burn away the debt. This is the bonds are dead thesis. If interest rates are kept artificially low, bonds will never offer a real return again. So the pension fund cannot rely on bonds for income. They have to rely on capital appreciation. They need assets that will float up on the wave of printed money. Stocks do this to an extent. But stocks are volatile. Gold does this perfectly. It is the cork that floats on the ocean of liquidity. The more money they print, the higher the cork floats. Pension funds are essentially betting on fiscal dominance. This is the economic term for when the government's debt is so big that the central bank has to print money to fund it. In a regime of fiscal dominance, inflation is a feature, not a bug. They will inflate the debt away. And if you are holding cash or bonds, you are paying for it. Pension funds are refusing to be the victim. They are opting out of the tax. Buying gold is a way to opt out of the inflation tax. It is a defensive shield against the inevitable devaluation of the currency. They are looking at the 1940s. They are looking at the 1970s. In those periods, bonds got crushed. Gold and commodities soared. History doesn't repeat, but it rhymes. And the pension funds are listening to the rhyme. We need to address the ESG contradiction: environmental, social, and governance. Pension funds are obsessed with ESG. Mining gold is dirty. It uses cyanide. It digs up the earth. So how do they justify buying it? This is where the hypocrisy reveals the desperation. They are bypassing the environmental part because the governance part is more critical. The financial survival of the fund outweighs the carbon footprint of the gold mine. Also, they are focusing on recycled gold or green gold. But mostly, they are just ignoring the ESG concern because the financial risk is too high. This proves how scared they are. They are willing to violate their own woke principles because the math demands it. When a pension fund that preaches about climate change starts buying gold bars, you know the situation is dire. Survival comes first. Virtue signaling comes second. They are quietly rewriting their own rules to allow for this. They are classifying gold as a strategic reserve rather than a standard investment. This semantic trick allows them to bypass some of the ESG screens. It shows you the power of necessity. When the ship is sinking, you don't care if the lifeboats are made of eco-friendly plastic. You just get in. Let's look at the volatility dampener effect. This is pure portfolio theory. Adding a volatile asset to a portfolio can actually lower the overall volatility of the portfolio. It sounds counterintuitive, but if that asset zigs when everything else zags, it smooths out the ride. Gold is volatile on its own, but combined with stocks and bonds, it reduces the drawdown. The drawdown is the maximum drop from the peak. Pension funds hate drawdowns. If a fund drops 30%, they have to send letters to members. They get sued. Regulators come knocking. If holding 5% in gold reduces that drop to 20%, it is worth it. It buys them peace of mind. It buys them job security. The Sharpe ratio is the metric they use. Risk-adjusted return. Adding gold historically improves the Sharpe ratio of a balanced portfolio. Again, this is the math speaking. The algorithms are telling them to buy. It is not a hunch. It is a calculation. And in the world of high finance, you cannot argue with the calculation. What about the currency war aspect? We are seeing competitive devaluation. Japan is destroying the yen. China is managing the yuan. Europe is struggling with the euro. Every country wants a weak currency to boost exports. It is a race to the bottom. In a race to the bottom, who wins? The guy standing on the sidelines holding gold. Gold is the only currency that cannot be devalued by a government decree. Pension funds operate globally. They have exposure to yen, euros, pounds. If all these fiat currencies are sinking relative to real assets, the fund loses value. Gold is the common denominator. It is the measuring stick. By holding gold, they are hedging against the entire fiat currency experiment. They are acknowledging that the last 50 years of fiat money might be an anomaly, a temporary blip in history, and we might be reverting to the mean. Reverting to a world where money has to be something real. They are not betting on the end of the world. They are betting on the end of the easy money era and the beginning of the hard choices era. Hard choices require hard money. Part 6. Let's go back to the liquidity trap. Imagine a scenario. Another pandemic, or a war, or a cyber attack on the banking system. The digital ledgers go down, or the bond market simply stops trading because no one knows what anything is worth. How does a pension fund pay its pensioners? They need to sell something. In a true crisis, cash is king. But what if the cash is trapped in a failing bank? Gold is the ultimate liquidity. It is the only asset that has never gone to zero. It is the only asset that trades 24 hours a day. In every country, in every culture, you can sell gold in Beirut, in Mumbai, in Shanghai, in New York. It is universal. For a global pension fund, this universality is a safety net. It is the ultimate insurance policy against a localized system failure. If the US system freezes, they can sell gold in London. If London freezes, they can sell in Singapore. It gives them options. And in a crisis, options are priceless. Most assets are tied to a specific legal jurisdiction. US stocks are under US law. Gold is physical. It respects the laws of physics, not the laws of Congress. If you hold it, you own it. This jurisdictional agnosticism is key for international funds. They want an asset that speaks every language. Consider the psychology of the exit. The 60-40 model is a crowded trade. Everyone is doing it. If everyone tries to sell their bonds at the same time, the price goes to zero. The door is too small. Pension funds know this. They know that when the stampede happens, they will get crushed. They need an asset that is outside the theater. Gold is outside the theater. It is not part of the debt matrix. Owning gold is like having a private helicopter when the Titanic is sinking. Everyone else is fighting for the lifeboats, cash. You are already in the air. This is the asymmetric upside. The downside of gold is limited. It might go down 10 or 20%. The upside? If the monetary system resets. If we go to a new Bretton Woods. If the dollar collapses. The upside is hundreds of percent. Or thousands. For a pension fund looking for growth, this asymmetry is attractive. Low risk of zero. High probability of explosive growth in a crisis. It is a convex trade. And smart money loves convexity. So what does this mean for you? Why does it matter if a bunch of suits in a boardroom are buying gold? It matters because they are the smart money. They have the best analysts, the best data, the best connections, and they are betting against the status quo. They are betting against the dollar. They are betting against the bond market. They are betting that inflation is here to stay. If they are right, and they usually are in the long run, then the strategy of the last 40 years is dead. The save cash and buy an index fund strategy might not work this decade. You are in the same boat as the pension funds. You have liabilities, your cost of living. You have assets, your savings. If the pension funds are hedging with gold, maybe you should ask yourself why you aren't. They are building a floor. A price floor, with trillions of dollars of potential demand waiting to enter the market. The downside for gold is disappearing. Every time the price drops, a central bank or a pension fund steps in and buys the dip. They are putting a safety net under the price. This is creating a gold put. Just like the Fed put used to support stocks. The institutional bid is the new support level. This changes the market dynamics completely. It reduces volatility. It creates a steady, upward pressure, a slow grind higher. This is not a crypto pump and dump. This is a tectonic shift. Slow, powerful, irreversible. We are witnessing the remonetization of gold. For 50 years, gold was demonetized. It was a commodity, like copper or wheat. Now, it is becoming money again. It is becoming collateral. It is becoming a Tier 1 asset. The wheel of history is turning. We are going back to basics, back to value, back to reality. The paper experiment is fraying at the edges. The accounting tricks are running out of road. The pension funds see the cliff, and they are packing parachutes made of gold. The 3 secrets are out. 1. Liability hedging in a negative rate world. 2. Zero correlation when everything else crashes. 3. Regulatory approval to treat gold as cash. These are the drivers. They are not emotional. They are structural. And structural drivers last for years, decades. This trend is just beginning. The herds have not arrived yet. Just the scouts. When the herd arrives, when the average pension fund goes from 0% gold to 5% gold, the price will not be where it is today. It will be in a different stratosphere. You have the information now. You see the cards on the table. The biggest players in the world are changing their game plan. They are quietly moving to the exit of the paper casino. They are cashing out their chips for something real. The question is, will you stay at the table playing a rigged game? Or will you follow the smart money out the door? The choice is yours. But remember, in the game of musical chairs, when the music stops, the only thing that matters is what you are holding in your hands. Paper burns. Gold remains. This is a battle for the preservation of wealth in a dying system. A battle between the promises of politicians and the laws of economics. History shows that economics always wins in the end. The pension funds have placed their bets. Now it's time to place yours. If this video opened your eyes to the machinery behind the curtain, if it made you think differently about your own future, then don't just close the tab. Share this with someone who needs to wake up. Leave a comment below with your prediction. Will we see a sovereign debt crisis in the next 5 years? I want to read your thoughts. Thank you for watching. Stay critical. Stay prepared. And I'll see you in the next video.